I want to show you how leases are presented on the company's financial statements. And specifically, I want to focus on the statement of financial position and the income statement. And so let's start with lessees. With a lessee, you're going to have a right of use asset on the statement of financial position and a lease liability. Now, lease liability is typically going to have a current and a non-current portion, and you'll see that in the example I'm going to show you in a minute. So the right of use asset, lease liability need to be presented separately, either in the statement of financial position, or if they're not there, then presented separately in the notes to the financial statements. Now, on the income statement, you're going to see interest expense for the lease liability, and then the lessee also needs to record depreciation expense for the right of use asset. Now, the depreciation expense in the example you'll see is not a separate line item in the income statement, but it is disclosed in the notes, which I'll show you in the next video, which I'm going to talk about lease disclosures. Okay, so this is a lessee. You got the statement of financial position, you got the income statement. Okay, now the lessor, okay, it depends on whether it's a finance lease or an operating lease. So a finance lease, the lessor is going to remove the asset from its statement of financial position. So if this was a manufacturer or dealer and it was like a sales type lease, then they would remove the inventory. They basically reduce their inventory account and say, hey, this has been a sale, right? We've sold, and they're going to recognize cost of goods sold, which can go on the income statement. They're going to recognize sales revenue, right? So they would remove inventory from their statement of financial position and then have a lease receivable. If it's not a sales type lease, if it's more just a direct financing lease, there's no selling profit, then the lessor would still recognize a lease receivable, but when they remove the asset from their statement of financial position, they wouldn't be reducing the inventory account. Let's say they were leasing out like equipment, they would reduce the equipment account. Okay, so you're going to have, if it's a finance lease, they're going to be recording a lease receivable, and then they're going to be recognizing interest revenue throughout the lease term. Whether it's a sales type lease or not, whether they're a dealer, manufacturer or not, they're going to be recording interest revenue if it is a finance lease. Okay, the difference in terms of whether it's just interest revenue or interest revenue plus selling profit depends on whether they're a manufacturer or dealer and whether they were selling inventory here. Okay, now if it's an operating lease, you're not going to have any lease receivable, and the lessor is not de-recognizing the asset. They're not removing it from their statement of financial position. So they're going to continue to depreciate the asset. They're going to depreciate the asset over its economic life. And then instead of recording interest revenue or any kind of selling profit, they're not going to have that. They're just going to recognize lease revenue on a straight line basis. So this is a summary. Let's look at an actual company. So we'll look at Carrefour, okay, the French company. And we've got here their statement of financial position. This is just the asset section here. It's really large. I'll show you the rest in a minute. But you see right of use assets, okay. Carrefour is a lessee. Okay, they are a lessee, and so they've got a right of use asset here of, looks like 4.5 billion euros. Okay, right of use assets. Now note that that is disclosed separately from their lease liability. So here we've got the liability and equity section of their statement of financial position, and you see there actually, we've got this lease commitments. So this is the lease liability. You see it in two places, because remember I said there could be a current portion. Okay, so this is the portion less than 1 year. Okay, so those are lease payments and so forth that are going to be due in the next 12 months. And then you got more than 1 year. So we've got a current and a non-current portion of the lease commitments. Okay, but notice again, we've got the lease liabilities, right? Oh, let me back up. Lease liabilities here and here. You add those together, this 936, and then this 3.7 billion euros. Add that. Add these two numbers together. That's the total lease liability for Carrefour. Okay. Now, so we got the right of use assets, and then we have, if you add this and you add this, you have the total lease liability, and they're disclosed separately. Now, if we move to Carrefour's income statement, okay, so now we're at their income statement, you see that they've got interest here, net interest related to lease commitments. Okay, so this is 113, these amounts are in millions, so 113 million euros in terms of interest expense related to those lease liabilities that they had that we just saw in the statement of financial position. Now, this has to, so this interest expense, it has to be disclosed separately from depreciation expense, okay? So they have done that here. It's its own line item, but I don't see here depreciation expense as its own line item. We see depreciation here in like SG&A and things like that. So I don't know which of the line items it's included in here, but that's okay because in their disclosures, right, they don't have depreciation expense as a separate line item here. but they do disclose what it is. When they make the disclosures, they talk about here's our right of use assets, here's the different type of right of use assets, and here's the depreciation expense that pertains to each one. And they make those disclosures in the notes of financial statements, which I will show you in the next video.